Hi, this is Alan House. I'm a senior analyst here at ValueLine. I'm joined today by two other senior analysts, Sharif Abdu and Charles Moran. We here at ValueLine hope you and your family are staying safe and dealing with this difficult time as best as possible. Today we're going to provide an update on the coronavirus and its ongoing impact on the economy and stock market. We will also discuss the actions ValueLine is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and level of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Now let's discuss the coronavirus, the economy, and the stock market. This content was prepared by our chief economist, Harvey Katz. Anxiety was high on Wall Street as October drew to a close, with this uneasiness reflecting a jump in COVID-19 cases, a frustratingly uneven economic recovery, long-running stimulus talks, a bitterly contested election, and still high PE multiples. Let's take a look at each of these issues. First, COVID-19. This monumental pandemic, which has traveled the globe and taken more than 220,000 U.S. lives, has remained stubbornly persistent. At this time, experts describe a third wave, with infections climbing in a majority of the 50 states and much of Europe. All the while, the world awaits a vaccine or an effective treatment. The economy. Business activity turned on a dime following the early spring COVID-19-induced collapse. However, after that initial liftoff, the comeback has turned somewhat choppy. For example, we recently saw better data on the consumer side as reports showed a nice jump in retail sales and further strength in housing activity. At the same time, there were surprising declines in industrial production and factory use. Nowhere, though, is the situation more muddled than on the employment front. There, job growth has slowed, and weekly jobless claims recently were knocking on the door of 900,000. It is little wonder, then, that the Federal Reserve has been clamoring for a new fiscal stimulus package from Congress. The election. Here as well, the stakes are high from both economic and regulatory standpoints, and the picture is murky, with the outcome of the presidential contest now just days away, perhaps in doubt until well past Election Day. Control of Congress is also up for grabs. Corporate earnings and PE multiples. So far, third quarter earnings are coming in better than expected. Still, a number of companies are warning of possible disappointments down the road. All the while, high earnings multiples, exceeding a median of 21 in the ValueLine universe, are unsettling investors. Nevertheless, markets are persevering for the most part. We think this overall resilience reflects the fact that the Federal Reserve is pulling out all the stops to keep the economy rolling. Also, attractive alternatives to equities are hard to find in this low interest rate environment. In conclusion, we think investors need to stay calm but also alert to developments. Please refer to the inside back cover of Selection Opinion for a statistically based asset allocation model's current reading. I want to touch on one sentence of Harvey's view and quote, "We think investors need to stay calm but also alert to developments." We certainly hope that there are good reasons for investors to stay calm, but we still have some concerns. As stated earlier, the current economic situation remains difficult, and it's going to take a while to recover. Many in the medical community also assume that another wave of COVID cases could hit this fall or winter, which should, of course, significantly hamper a recovery as well as introduce new problems. While I don't think the stock market will retest the lows from February, I would not be surprised to see some backtracking, and even if the major indexes do advance from here, it probably won't be a straight line. Thus, we recommend that investors tread carefully and prepare for a bumpy ride. On that note, ValueLine is providing a great deal of information and analysis to help our subscribers. We know that most of our readers depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, ValueLine provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of ValueLine's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and the shareholders. This content is posted throughout the day on our website. Once again, that's www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I'm currently located. This is the main landing page for subscribers. Under the quick link, click on Supplementary Reports. As you can see, the research department has been very busy publishing our updated thoughts on the stock that we track. We strongly suggest that subscribers visit this page often. We are also aggressively adjusting our financial strength grades. Individual companies are dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Consequently, corporations have been implementing cash-saving initiatives such as headcount cuts, the slashing of advertising budgets, and reducing or eliminating the dividend. Taking on additional debt has also been popular as a means to build cash in anticipation of difficult times ahead. Due to a rapidly deteriorating balance sheet, ValueLine has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection Opinion newsletter. For those of you who don't know, financial strength, along with price stability, another proprietary ValueLine measure, are the two metrics that are used to calculate a stock safety rank, a measure which is a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, ValueLine provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during and after this pandemic runs its course. Okay, now for the intro to the stock screener. So we're going to move on to the one stock to buy right now. For this, let's go to the screener, which we click right up here. Okay, and then ValueLine subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-ValueLine. Since I earlier preached caution, I'm going to create a screen that only focuses on the most stable and successful issues. There are loads of risk measures out there and several that ValueLine offers Now I'm going to start with our time-tested safety ranks. So we're going to click on the safety ranks first. And we're going to go with only stocks that are ranked 1 for safety. Our scale goes from 1 to 5, 1 being the safest. As you can see by this screen, we have 128 stocks that are currently carry the highest safety rank. So now we're going to go with an additional level of security. As mentioned earlier, loads of companies are reducing headcount, taking on more debt, and eliminating their dividends. Thus, balance sheets have greatly weakened. Although it's already a factor in the calculation for safety, I'm going to double down and include the financial strength. These grades range from C to A double plus in 9 increments. I am only going to focus with the double A's here. I want the strongest companies. So we're going to go down to the financial strength and pick only those that are A double plus rated. As you can see, we're down to 54 stocks. So we're whittling the list down. Okay, so we're going to narrow that list down a little further. For that, I include timeless rank, which is a proprietary value line measure evaluating a stock's projected price performance in the coming 6 to 12 months. It's a straightforward scale from 1 to 5, with 1 being the highest. I want to focus on the stocks that, based on our projections, have the most promise in the near term. So I'm going to set that screen for timeliness. I'm going to pick stocks that are ranked 1 or 2. That's timely stocks. 1 or 2, they're both timely. And as you can see, now we're down to 22 stocks in our screen. And finally, we want to whittle that list down even further. And for that, it's always good to have a dividend component, for conservative portfolios. So I'm going to do a dividend yield with a lower bound of 2.5%, which is higher than the ValueLine median. So we're going to hit that filter for that. And lo and behold, we are down to nine names now. As you can see, these are all large, well-capitalized companies with long track records of steady increases in the payout. You can certainly make an argument for any of these remaining stocks, and investors interested in adding new positions should consider them. However, only one stock can be today's one stock to buy right now. And after consulting with a number of my senior analysts, we prefer and recommend PepsiCo. The ticker is PEP. Before I go into specifics, please note the screens can be saved and revisited by utilizing the button at the top. Now let's click on PEP, PepsiCo, and get some additional information from ValueLine's digital report. PepsiCo will likely register flat results this year, which is fairly impressive given the difficult operating environment. While restaurant-based demand has been hurt, work-from-home initiatives have resulted in heightened demand in e-commerce at large retail chains. This has helped to offset sluggish results at restaurants and other venues. We look for sales and share earnings to advance next year, as work-from-home initiatives likely continue, while other segments will likely benefit as the U.S. and international markets continue to open up on a broader scale due to probable improvements on the COVID-19 front. As you can see in the banner section here, PepsiCo stock currently trades at $133.95. Our 3 to 5 year price target is also $140 to $175. Now let's take a look at our last full page report on Pepsi. I'm going to click down here, October 16th, 2020, which is just about 2 weeks ago. As you can see in this, as you can see in the statistical array at the center of the report that includes the financial data, PepsiCo appears poised to achieve healthy annual increases in revenues, profits, and book value, among other measures. We look for the company to post relatively stable results this year, which is a good showing given the recent state of the economy. PepsiCo is well diversified as snacks and beverages each account for about 50% of the top line. The company also has a juice and sports drink arm which is generally viewed as a healthier alternative to the traditional Pepsi soda brand. We don't believe that the upcoming election will alter the company's outlook much, but I think its defensive nature ought to enable it to withstand the COVID-19 pandemic. Coronavirus cases are spiking again in the U.S. and other parts of the world and may continue to do so until a vaccine or other treatment is discovered. As mentioned earlier, more people working from home, which ought to help lift sales. What's more, people have been stocking up on food items since the pandemic began here in the United States in mid-March, which has also helped support profits. We believe that people will continue to purchase Pepsi-branded products despite a likely uneven economic recovery due to strong brand name recognition and competitive price points. As you can see, the company's balance sheet down here, the current position, the capital structure, remains in pretty good shape with cash on hand of about $9.7 billion as of the end of the September quarter. This provides a level of support during these difficult times. The company's dividend yield, as you can see up here, of 3%, exceeds the ValueLine median, while it is also well covered from cash flow from operations. Also, the stock holds our highest score for price stability, which you can see down here of 100, as well as a perfect score for earnings predictability of 100. Also, we think that PepsiCo's position is quite strong, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that we typically can't answer complex questions about specific about specific stocks on the spot. For this, we recommend you peruse one of our latest reports on the stock. With that, I'll now hand the ball over to Sharif and Charlie for questions. Thank you for your time.
Thank you, Alan. This is Charlie Moran. I'm joined by Sharif Abu, and we're taking questions now. You can ask some questions now. We have some prior questions submitted prior to the report presentation. I guess I will go first. The one that I received was from Denise asking about the difference between the dividends declared per share box in the array and the bottom left-hand corner dividend box that I think you can see if Alan scrolls up a little further, that the quarterly dividends paid, those sums are different because one is the one in the array is based on the declaration of the dividend as opposed to when it is paid. And her follow-up was regarding why there were dashes in the December quarter, and it appears that both of the first quarter payments occurred in January, February, and March, such that there were no payments in the October, November, and December period. Sharif?
Hi, thank you, Charlie. This is Sharif Adu. And I see one question here, which is kind of interesting, a bit thorny, but this is an interesting question. Monitoring all the tumult at HSBC, how do you think any of the large U.S.-based banks could face similar difficulties? So I'll say first, it's kind of a slightly different situation here. The national domestic banks in the U.S. are very well capitalized. They are geographically diverse, and I think the most encouraging thing is that they're backed by the efforts of the Federal Reserve, which seems to be bending over backwards to pump liquidity into the market and keep interest rates low. HSBC is kind of an interesting company. It reminds me, so I cover HSBC, just full disclosure. It's one of the stocks that I personally cover and write reports about. And HSBC actually reminds me of another company that I cover, Citigroup. But it reminds me of Citigroup about 10 years ago. Citigroup is a very different company today than it was about a decade ago. So HSBC is kind of it's kind of like a hodgepodge of different things that are kind of smashed together. It's a challenging company to cover because it really is like 5 different companies that were kind of mashed together. And about a decade ago, that was the way that the U.S. banks were trying to go, led by Citigroup at that time. And it was the financial supermarket model. You want to bring together retail banking with investment banking, with research, with all these different things. And sometimes there were some conflicts of interest there, as far as, some conflicts could arise because of the fact that you have all these different pieces. And HSBC reminds me of that right now. They are now in the process of trying to cull some of those operations. They're actually conducting a strategic review right now, trying to decide what they're going to keep, what they're going to get rid of. Which is a very painful and lengthy and costly process. That's the same process that Citigroup went through about a decade ago. So it's a little hard to compare what's happening with HSBC, and there has been a lot of tumult, no question. They have a new CEO. They're having a headcount reduction. They're cutting 35,000 positions. There's a lot going on there. So it's hard to compare what HSBC is going through with like the US-based, the large national banks, your Citigroup, JP Morgan, Bank of America, et cetera. I think the US-based banks are actually, they're actually in pretty decent shape. So I wouldn't have too many concerns, even though their share prices have been really lagging the market so far this year. So that's it for that question. Charlie, do you see something that's interesting?
Yeah, Farhad just wrote a question regarding the ValueLine report stating long-term investors waiting for a better opportunity for the Pepsi stock since the capital appreciation potential over the time frame out to 2023 and 25 is below average. And he asks, what is the appropriate entry point? And that is a good question that we often get, and it really depends on your time horizon with regard to your investment. As Alan kind of alluded to, Pepsi is a relatively safe stock that is also ranked 2 in terms of timeliness. So for shorter-term investors, that makes it an appealing choice, both from a safety perspective as well as a short-term performance perspective. Over the long term, however, we are a little more concerned about the valuation perhaps becoming a little less generous in terms of the multiple. I don't know if you can see the multiple, if Alan can expand on the page here going up. But when you look at the 3 to 5 year multiple going out, you can see that the analyst has, where Alan is the cursor, has estimated that the average annual rate P/E ratio will be at about 20 times 3 to 5 years hence. And that's, again, a projection. As of now, the P/E ratio is 25 times approximately. So this is not to say that Pepsi's long-term operating performance is necessarily less desirable, but we do assume that the multiple will contract a little bit, and I think that makes it a little less of an appealing choice for the longer term, as opposed to the timeliness rank, which projects for the next 12 months. Sharif?
Thanks, Charlie. C1 here. This is another tough question to answer here, but it's an interesting question. He says, Stephen says, parts of the country are still in lockdown, and the prospect of additional lockdowns to battle future waves of the coronavirus is increasing. I guess he means the chances of additional lockdowns is increasing. What is ValueLine's outlook on the restaurant industry and its suppliers and vendors? So I would say we need to make a distinction between the publicly traded restaurant industry. So these are like your large national restaurant chains, McDonald's, Wendy's, Chipotle, Olive Garden, that Chili's, that type of thing. So we need to make a distinction between the publicly traded restaurant chains from their suppliers, or from restaurant suppliers, I should say. The national chains are very well capitalized. I mean, these companies are not going anywhere. Your McDonald's, that type of company, their operations are geographically diverse. McDonald's has, they have stores in all 50 states. They have lots of operations overseas. They also have marketing muscle to generate sales through delivery services such as Uber Eats or Grubhub, Postmates, that kind of thing. So the lockdown has obviously affected these companies, but it hasn't been, for lack of a better word, it wouldn't be like a death spiral situation where they can't have their doors open, customers can't come in and eat and buy their products, and therefore they're at very serious risk. That's a very different situation. Then you have companies that supply McDonald's and Wendy's and Chipotle and Chili's and that kind. Those companies are going to be fine. They're suppliers, just because those contracts tend to be very long-term in nature, and McDonald's, et cetera, are still selling product. So their suppliers will be fine. The companies that I would be a little bit more concerned about, and I don't use that lightly, I don't use that phrase lightly, that I would be a little bit more concerned about is a company that supplies your independent restaurants, right? Not the supplier to McDonald's, but the supplier to independent restaurants, your kind of mom and pop operations, privately owned, local restaurants. The suppliers for those restaurants, they're the ones that I would be a little bit more concerned about. So, for example, there's a company called the Chef's Warehouse, and they operate in the United States and Canada. And the company was doing pretty well before 2020, before coronavirus and everything else happened, and the lockdowns and people staying home. They were in the sort of high growth phase of their existence, where sales were growing rapidly. They were kind of right along the razor's edge between turning a profit or a small loss. But that was acceptable then because it was in the high growth phase of their, that was that phase of the life of the company. What's happened to companies like the Chef's Warehouse, and their primary customer base is independent restaurants. Because of the lockdowns, those independent restaurants are struggling right now. Because they don't have the marketing muscle of like a McDonald's, they don't have the ability to keep their doors open. That is in turn having a really detrimental effect on companies like the Chef's Warehouse. So those are the companies I would be a little bit more concerned about. The national chains, just to take an overview again and just look at the big picture, the national chains are going to be fine. The suppliers for the national chains are going to be fine. Companies that are sort of catering to independent restaurants maybe could have some trouble here. And I would be very cautious if I'm examining or considering an investment, making a commitment to one of those companies. And that is it for that question. Charlie, do you see anything that's interesting?
Yeah, I would definitely echo that. A lot of these small independents do not have the financial resources to compete, and it's going to be interesting to see how that situation evolves over the next few months.
Absolutely.
The questions I had were kind of all similar to asking about growth stocks, and I think one captured it I think Pascal asked about he had a question regarding why are these stocks not, why are they value stocks and not growth stocks that we are choosing? And he asked something to the effect of, where can I find stay-at-home stocks that have high momentum? And it seems as though that's a common thread in some of the questions. And as far as the stay-at-home stocks being kind of more value-oriented, that's just generally going to be the case, given, historical operating trends. Just because they're very hot right now doesn't mean that they aren't subject to the normal operating results that the demand that they had in years prior to the pandemic. But as far as finding high momentum stocks, although we don't classify that by sector, what you could do if you're just looking at price action is focus your attention on technical ranks or the 18th month target price range, and those are filters that you could put forth in the screener and screen stocks with those conditions. But as I said, you'd have to kind of separate those stocks that have high momentum or are considered stay-at-home. As it's a loose definition. I can tell you, in terms of food stocks, one that I cover is Beyond Meat, which would be considered a high momentum stock. But that's mostly a function of the fact that they are relatively small compared with the Kellogg's, General Mills, and the Pepsis of the world, and they're an incredibly high growth niche or subsector of the food market. Sharif, anything else on the question front?
So I see one question here, which is actually a very good question, but it's kind of a straightforward question to answer. So Rajesh, I hope I pronounced that correctly, Rajesh, how to interpret the graph? And I am assuming that Rajesh means the price chart. And if you see where Alan has the cursor right now. So this one's actually pretty simple to answer. So if you look at the solid line, that solid graph line that goes straight through, and it's moving up, 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 and then at some point it becomes a dotted line. And then if you look throughout all the years, say starting in 2010 through 2020, you'll see little tick marks on the graph. See all those little tick marks? Look like little vertical lines. So all those little tick marks are the highs and lows for the share price. Those are actual numbers. Okay, that is how the stock actually traded. And then if you look at the solid line that I just described earlier, that is the value line. So that's what the company's named after. It's sort of our calling card. It is the value line. So that is a simple projection that we make based on, for most companies, it's the cash flow per share multiplied by a certain cash flow multiple that we choose based on certain criteria. So if you look at the Pepsi report, for example, and we look in the Legends box, which is just above the graph, right? That's where Alan has the cursor right now. So the cash flow multiple that we chose for PepsiCo is 15. And that's based on, a lot of different criteria. It's sort of a reverse engineered number, to be perfectly honest. We choose that number of how we think, it's the multiple that we think will get the share price to the number that is appropriate relative to how the stock has traded historically, if that makes sense. So it's a reverse engineered number. So if the actual numbers are below the solid line, our solid cash flow line, that means that the stock is sort of a buy. It's undervalued. It's a good time to buy the stock. If the actual share prices are above that line, above the value line, that means that the stock, according to our projections, I want to specify that, according to our projections, the stock would be considered maybe a little bit overvalued, maybe slightly overvalued, slightly overpriced. So that's what the graph means. It's just meant to be a quick, simple way to visualize whether the stock is above the value line or below the value line. Is it appropriately valued? Is it overvalued, undervalued? That's what it's meant to be. That's how it's meant to be interpreted. I hope that answers the question for Rajesh. Charlie, do you see anything else that jumps out at you?
Yeah, I believe it was Walter who asked, or no, Clifford asked a question regarding Pepsi versus Coke and how Pepsi will perform under increasing competition, as he phrased it, from Coke. And I just wanted to state that, these are individual analysts. Sometimes an analyst will cover competitors within an industry. I think that these two companies have different analysts, but just as a reminder, just because they are considered a duopoly in the beverage space doesn't mean that they are going to have similar prospects. That said, I believe Coke has a timeliness of 3. PepsiCo has 2. And also, if you look at the composition of the business, Coke does not have a snack foods business, which is apparently doing quite well for Pepsi. If you wanted to find out more about the business lines, Alan thankfully scrolled down to the middle of the page. As you can see on Pepsi, if he can enlarge it, the company derives, I believe, about 50% of their operating profits from Frito-Lay, which they own. Thank you, Alan. And although that's only 25% of sales, they did account for about 51% of profits. To my knowledge, I don't think that Coke has a food segment. If so, it's rather small. And also, I know, having looked at Coke, that they are going into hard seltzer business is going to debut in 2021, and they have a much larger international business than Pepsi. So again, often when you think of these things being quite similar in terms of their markets, they can be actually quite different when you drill down and look at the composition of the business lines. Also, they can have different balance sheets, although they are both similarly capitalized. And also, they both have financial strength rankings and, I believe, a safety rating that's very similar as well. So just to kind of clarify that again, just to say that these are individual reports by often analysts that are different within the industry, and that goes for all industries within the survey. Sheree?
Okay, Charlie and Alan, I don't see anything else that is jumping out at me at this time. Charlie, I don't know if you see anything else that's grabbing your attention.
No, that's about it.
Okay, I think we're gonna just turn it back over to Alan for a minute to close things out. Alan?
Okay, thank you, Charlie and Sharif, for answering those questions, and thank you for asking the questions. They were very intriguing questions, and thank you for your participation